Hello and welcome everyone. Today I would like to share with you guys one good option or strategy of incorporating options into your overall investment strategy, and that is using options as a hedge against market volatility, especially around market making events like earnings. And I would like to use this one company as an example. The company that I would like you guys to pay attention to is Duolingo, ticker symbol DUOL. It had its earning yesterday afternoon after market closed, and today it tumbled 25%. So if you were a long-term investor in this company, then essentially your investment is worth 25% less than it was yesterday. So you could use, if you are an investor in one of these volatile companies, you could use options as a strategy to hedge against that. For example, if you were a long-term investor in this and you really believe in this company and you just want to protect yourself from these short-term market movements, then it really would benefit you just to buy a few contract of puts whenever there is any market moving events taking place. And I will show you what the price of those contracts would have been yesterday. So, for example, the closing price for this company was $260 yesterday. Today it is around $193, I believe. And the premium, because of this a growth company, is very volatile company, so it will demand a higher premium for an option contract. So the premium for an option contract at yesterday's closing price was $23, which will roughly translate to $2,300 per contract. So that means if you bought yesterday one contract, it would have cost you $2,300. And if this stock, instead of the way it went down today, actually went up or stayed neutral, then you would more or less would have lost, not all of it, but you would have lost majority of that premium. You could have still, since yes, today is a Thursday and you have till tomorrow, the premium will definitely would have went down a lot. But still, it wouldn't go to zero if you buy close to the money line, if you will. But let's assume that you bought yesterday one contract for $2,300 at a $260 money line. So then that means today that contract would have been worth about $7,000, a little bit above $7,000. And so that basically would have softened your blow if you were invested in this by about 4,000. If you subtract your initial investment, about $4,700. So this is why in using options as a hedge is a really good idea. And you will lose some money if the company goes the way you were intending it to go, but you're not gonna worry about it because that means you made some money and the company it is as you suspected that it would be. But let's say if you were wrong, then this one is a sort of an insurance policy. So this is one good reason to buy or to add options to your overall investment strategy. As you can see, my account is still not funded, but my intention is to fund this account to $1,000, and my goal is to basically double this every 3 months, every quarter. And if you don't mind, or if you want to come along, I will be sharing with you guys the companies that I will be buying the options from. I want to invest this $1,000 into options for to from companies around the and what do you call market making events, like an earning close to the earning season, close to their investment and the investment days, you know, or delivery days in case of a Tesla. So I will share with you guys what my overall thesis is when I'm buying an option from a company, and then at the end I will also share with you guys the results of my trades, good or bad, So we could, as a community, more or less share, what I did wrong, what I did right, what do you think I should do. I would be more than happy to take anyone's what do you call advice, if you will. But I will be, hopefully starting that and sharing with you guys as I go along. But in the meantime, take good care of yourself and see you next time. Bye bye.